Hello, everyone. Thank you for coming to our webinar today. The Junior Economic Club is honored to have Jay Bryson, the Chief Economist at Wells Fargo, talking to you guys today. The Junior Economic Club was founded in 2014 and is an entirely student-run nonprofit that introduces high school students to business and economics through our various events, forums, and community initiatives. We have over 100 students representing over 25 high schools across Chicago, as well as chapters in 9 cities across 4 countries. And you can learn more about the club and admissions at junioreconomicclub.org.
Yep. Well, thanks, Leo. So as you can see here from this is my biography here. I'm going to walk through it, not to to talk all about myself or to bore you guys or anything like that. There is actually a method to the madness, and I'll try to draw out some of the points when I'm done with it. So as you can see, so I got a BA in economics from UNC Chapel Hill back in 1980. So all you guys can do the math, so you know how old I am now. I wasn't like I was a child prodigy and graduated from college when I was 8 years old or anything like that. So you can kind of figure it out. I went there not really knowing what I really wanted to do. I thought maybe I'd want to be like a doctor or something like that. And I was kind of on that track in my freshman year. Took a bunch of science classes and that sort of stuff. And come the spring semester of my freshman year, I took an economics course and just kind of fell in love with it, and switched to being an economics major at that point, and never really turned back. So I graduated in 1980, and I thought that that would be the end of my academic sort of career. I took a job as a marketing representative for Armstrong. So Armstrong at the time made floors and ceilings and things of that nature, and I was posted up in Minneapolis, and really enjoyed Minneapolis, but I hated the job. It was kind of a sales sort of job, and it just really wasn't cut out for me. And so at this point now, I'm 23, 24, thinking, geez, what am I going to do now? And I thought, well, I always kind of liked school and economics and everything. And so I thought, oh, maybe I'll pursue a PhD in economics. So applied to a bunch of different graduate schools, got into a few of them, but I ended up going back to Chapel Hill, largely because they had a really good macro program at the time and something that I was interested in. And so, I was a graduate student in economics, as you can see, between 1982 and 1988. And then in that last year there, I was actually on the faculty at the University of North Carolina. I was what's called a lecturer. So I was teaching classes at the time. I was getting paid for it and everything. Didn't have my PhD yet. I was just finishing it up. And so, I spent a year being a lecturer there. And then in 1989, the summer of 1989, I got my PhD. And my first job out of the graduate school was I was an assistant professor of economics at the University of Alabama. So Alabama, it was a research sort of university. So you do a lot of I taught 2 classes per semester, in macroeconomics and international economics. Did a bunch of research, writing papers, and things of that nature. So at this point, relatively newly married. My wife is working on finishing up her PhD in political science, and she had applied to a bunch of programs in the Washington, D.C. area. And we decided we didn't want to be apart for a year, so I figured I would take a 1-year leave of absence from from Alabama and look for different jobs 1 year in Washington, D.C. And I landed a 1-year job at the Federal Reserve Board. And after about 6 months or so, I was really fascinated by the work the Fed does. And they were happy with the way I was planning out. And so they offered me a full-time job. And so lo and behold, I leave Alabama, and now I'm an economist at the Fed. And it was a great job. Part of what I did was I would follow the dollar in foreign exchange markets. And the really cool thing about the position that I was in is about once a month or so, I would brief Alan Greenspan, who was the chairman of the Fed at the time, and the other governors who sit there in Washington on what was going on in foreign exchange markets. markets. And, being interested in economic policy, having the ability to be briefing the chairman of the Fed was a pretty cool sort of thing. So also while I was there, I kind of kept my feet in academia. I taught at night, either at Johns Hopkins, the School for Advanced International Studies, which is in Washington, D.C., or at Georgetown. But in the fall of 1997, I get a phone call from the bank was called First Union at the time, which then became a few years later Wachovia, and then about 12 or so years ago was bought by Wells Fargo. But anyway, I get a call from somebody at First Union saying, which was a very large, one of the largest banks in the country at the time, based in Charlotte, North Carolina, and they're looking for an international economist, something that I was doing. And I had spent about 10 years of my life in North Carolina, had really liked it there, and the thought of going back to North Carolina was very, very appealing. And so decided to leave the Fed and relocate to Charlotte, and that's where we've been for the last 22, 23 years. The first job, as you can see there, at First Union, Wachovia, and then Wells, I was the global economist, so I had a background in international economics. So I would talk, I would write about what was happening in foreign economies, that sort of stuff. And then 2 years ago, I became the chief economist. So what I do now, we have a group of about 15 of us. Most of us are based in Charlotte, but there's about 5 or 6 who are based in New York City. And we do a lot of writing about what's happening in the economy. All this goes out to our clients. I do a lot of public speaking, or at least I did until COVID. I've been working at home for the last 6 or 7 months, or however long it's been now. And we do a lot of media. So I appear on CNBC, appear on Bloomberg, and talk to Wall Street Journal, New York Times, etc. About what we see is going on in the economy and what we think is going to happen here. So the point of all of this, and again, it's not to bore you with my 40-year career, is I just mentioned the word career. And I understand you folks are at a point where you're thinking about college first, and you're thinking about your next job, but or your first job, and there's obviously a lot of emphasis on that. But it is a career. It's a it's a marathon, right? And I went from thinking I was never going to go back to school, working as a salesperson, and did a complete 180. Went back to school, and although I've spent the last 30 some years being a professional economist, as you can see, I started out in academia, and then I moved to the public sector, being at the Fed, and for the last 20 some years now, I've been at the private sector. And so I would venture to guess 40 years from now, when you folks are looking back on your life, you'll have even more jobs than I did over that period of time. And who knows, you may do a bunch of career switches as you go along as well. So it's a marathon, it's not a sprint. And the point here is, I think you have to be prepared to make those sorts of switches, and you need an education that allows you to kind of do that. So Leo, can you move to the next slide, please? Right. So, why major in economics? I saw from the chats that a lot of you folks are interested in majoring in business, and that's perfectly fine, right? It's whatever you want to do. But this is directed more at this point to some of you who are thinking about majoring in economics, and I can speak very well about this because I obviously was a major in economics. I was a teacher, and so I've got a big background in here. So first of all, one of the benefits of majoring in economics, it's a liberal arts degree. And so, most colleges, you would have to take, maybe 9, 10 economics courses to become to major in that. But the good thing is you can also take lots of other different sorts of courses. So like, if you want to be an engineer, obviously you have to take an engineering degree to become an engineer. But then you're very limited to the number of other sorts of courses that you can take. And I have a BA in economics, not a BS, I have a BA. But when I think back to my college, my undergraduate career, and I've said this many times over the years, one of the most useful or interesting courses that I took, it was like the senior year, the second semester of my senior year, I needed one more humanities to fulfill my requirements. And so I thought, oh, okay, I like history, I'll take an art history class. That's a humanity. It was fascinating. It just really opened my mind to a whole different area of thought that I hadn't really thought about before. I had all this math and statistics and economics, but it was great to be able to take something from the humanities. And again, with economics being a liberal arts degree, it gives you that ability to take different sorts of courses rather than just a whole slate of finance courses or a whole slate of engineering courses or whatever. It's practical knowledge that many employers find useful. I'm not going to denigrate art history degrees or say French degrees or something like that. And if that's your passion, by all means you should do it. Okay, but it's also kind of difficult to find some jobs when you first come out of college. With economics, it's a very, very practical knowledge, and many I just know that many young people coming out with degrees in economics don't have much problem finding employment once they graduate from college. And then finally, it's a good degree for a lot. If you're thinking about going on to graduate studies, it's a good degree for that. I mean, the good thing about economics, economics is all logic, right? A causes B, which causes C, which then leads to D and E. And that sets you up for, an MBA. And so, if you are thinking about potentially majoring in business, but you're not really sure, I would say, if you would eventually want to go into business, maybe think about an MBA, because frankly, there's not that much of a difference between a BA in business administration and an MBA. They teach roughly the same sort of thing. An MBA initially was designed for people who don't have business degrees to teach them accounting and finance and marketing and things of that nature. A BS in economics, a BS or a BA in business and an MBA, in some sense, they're kind of redundant. Now, maybe some employers require people to have an MBA to advance further down the line. That's fine, right? But if you're eventually interested in business, maybe the MBA route is the way to go. But it's also very useful if you want to go into law school. Again, it's all about logic. Law is all about logic, and people get into medical schools with degrees in economics as well. So the point here, it's a good rounded sort of major, and you can find employment after college with that. Next slide, please. Okay, so in terms of careers in economics, and this kind of goes back to my bio, right? I started out in the academic side at the University of Alabama, and then moved to public government, and ended up then in the private sector. So in terms of academia, unless you want to teach at like a community college or a 2-year degree, a 2-year program or something like that, if you want to be an academic economist, you're pretty much going to need a PhD. All good universities, when you look at the faculty, they all have PhDs. And to go on to a PhD in economics, you need to have very, very strong math skills. That was true back in my day. That's even more truer today. Economics at a graduate level, it's all math. And you think about, you may have some economics courses now, and you're probably doing lots of graphs and things like that. When you think about it, a graph is just a picture of 2 mathematical equations. If you're really good, you can maybe get into 3 dimensions graphing, but after the 3rd dimension, you can't do it. Math is great because it's n dimensions. But again, to get a PhD, you're going to need really, really strong math skills. And so I know a lot of students who are thinking about going on into graduate studies, when they're getting a BA or BS in economics, they're double majoring in math. And if you tell me today, yes, I see myself going on and getting a PhD, I would strongly recommend to you to double major in economics and math as well, because you're going to need it. At the government, then there's the government level. So, at the Fed where I was, there was 250 economists at the Fed at the time. I'm going to say 98%, 99% of them had PhDs. So if you're going to go to a Federal Reserve and work there, you're probably also going to need a PhD. But there's also a lot of other places in the federal government, whether it's at the Treasury Department, the State Department, the Commerce Department, et cetera, where you don't necessarily need a PhD. Now, you may need a master's degree, and you could become a research assistant at the Fed. One of our daughters, who just graduated from Notre Dame last year, as with a degree in economics, she's working at the Fed now as a research assistant. And you can work as research assistants at the Chicago Fed, Kansas City Fed. There's 12 different Federal Reserve banks. And so that's a good job that you can get right out of undergraduate school. But if you want to make a career at the government sort of level, you don't necessarily need to have a PhD. And the same thing at the state and the local government sort of level. There's the state of Illinois, the state of Michigan, the state of Pennsylvania, et cetera, all hire economists there. And again, you probably don't need PhDs there. And then finally, in the private sector where I am, Wells Fargo is a Wall Street, sort of bank. A lot of our competitors, whether it's JP Morgan or Bank of America, Citibank, Goldman Sachs, et cetera, they all have economics departments. And most of the people there are not PhD economists. Many of them do have master's degrees, but I'm going to guess now, maybe a quarter of people who are at Wall Street sort of banks, maybe they have PhDs. Obviously I do, but it's not necessary to be there. And then there's also non-financial institutions, like very large businesses, like General Motors, Ford, Caterpillar, John Deere, places like that, DuPont, named big, large corporations that you've all heard of. They have economists as well. And again, a PhD is not necessary for some of those places. Next chart. Right. So Leo wanted me to touch on what's happening with college tuition and student debt and things of that nature. So let me finish by talking about that. So this chart goes back to 1978, and so there's two lines here. One is the overall CPI, and then the other one is college tuition. And so this starts back in 1978. It starts there because that's as far back as this series on college tuition goes. Both are benchmarked to 100 in 1978. And since then, you can see the overall price level as measured by the CPI has gone up 4x. College tuition has gone up 15 times since then. So clearly it's outpaced the overall rate of inflation. So why? Why is college tuition going up so much? Next chart. And so this will show you, at least from the demand side, obviously prices are determined by the interaction of supply and demand. I don't have a chart that shows supply here, but you can see on college level. So back in 1963, there was about 5 million people who were enrolled in college. And you can see by I think it's 2013, that had crested at 20 million. It's come down a little bit since then, but the point here, and then the line shows you at what share that is as a percent of individuals who are aged 18 to 25. And you can see that that has come up dramatically over that period of time. Okay, so the point here is the demand, and this, I'm probably not telling you anything you don't already know, the demand for college degrees has gone up. And everything else equal, if demand goes up, it's going to cause prices to go up. And that's what you're seeing there. Next slide, please. Okay, so in terms of student loan debt outstanding, so as you can see, if you go back to 2003, there was less than $300 billion that was outstanding. Today, that's $1.5 trillion. It's why is that? Well, the price of college is going up, and more people have gone into debt. Although we'll finish up here with a few bullet points, and it may not be exactly what you think, what's causing that. So next chart. So this just shows you delinquencies on different types of debt by category. And so what you do see is, if you look there at student loans, back in 2003, about 6% of student loans were delinquent, where they're more than 90 days past due. And today, as you can see, that has gone up to, I can't see the end of the slide there, but whatever it is, it's now the highest today. Sometimes I get the question about why is it that, or is this something we need to worry about? People look at student loans today and they kind of think about it in terms of potential the Great Recession, subprime mortgages, mortgage debt in general. Could this be another mortgage, sort of crisis? And so to put this in perspective, back today, there's $1.5 trillion worth of student loan debt. Back in 2007, 2008, at the height of that bubble, there was almost 10 times as many mortgages outstanding. So it's just not in the same ballpark. Is all the student loan debt going to get paid back? No. Will people who don't pay it back ruin their credit scores for a very long period of time? Yes. Will investors who own bonds that are securitized by student debt, will they suffer some losses? Yes. Is it going to bring the U.S. economy to its knees? Probably not. It's just not big enough. Okay, so it's more of the way I view it, it's more of a microeconomic issue than it is a macroeconomic issue. The mortgage crisis was a macro problem. This is more of a micro sort of problem than it is macro. And then finally, the last chart here, and I put this link in here. You guys can follow this. This was done by David Wessel, who's at the Brookings Institution now. He used to work for the Wall Street Journal. He's an economics journalist. And here's some facts about student loans. And what's interesting is 6% of the borrowers own a third of the debt. If you look at the median borrower, they have about $20,000 worth of debt. So you hear these horror stories of people who have $100,000, $200,000 worth of debt. Keep in mind, they're at the far end of the scale, right? The median borrower has, as you can see there, about $20,000 worth of student debt. The second one is borrowing for graduate schools accounts for about a third of the total debt. So for instance, you're lucky enough to get into Harvard Medical School. That's going to cost you what, $50,000, $60,000 a year or more. You can easily rack up $250,000 of debt going to Harvard Medical School. So again, a lot of it is at the graduate level, and the defaults are concentrated among individuals who went to for-profit institutions or two-year institutions. There's a lot of heavy marketing at some of these places to bring students in, and one of the ways they bring these people in is they say, oh, we can get you all these loans and everything. And some of these people graduate from some of these institutions with $20,000, $30,000, $40,000 of debt. and they're unable to find a job, and then they have a problem. And so the fourth bullet point from Wessel and his fellow researcher was most bachelor's degree recipients graduate with little debt to low debt. And the final thing is, many students also borrow to cover their living cost as well. That's one of the things you can do with student loans. It's not just the tuition and the fees. It's the total sort of thing.
Yeah, so thank you for sharing all of that. It was very interesting. But to begin with, I know you mentioned stuff about majoring in both math and econ. So what are some of the helpful, I guess, majors and minors to accompany an economics major?
Right. So I think part of it depends on what you want to do, right? So if you say, okay, I want to go into public policy or something like that, I really have an interest in that, then perhaps maybe your best double major or your minor there may be political science. But if you are interested in or maybe what you want to do is, I really want to run a portfolio for a mutual fund company. I want to study economics, but I really want to someday, be buying stocks and bonds for this portfolio. Then perhaps maybe your best minor would be like finance or something like that, accounting or something, right? But if you're thinking pure economics, I think what, again, I would stress here would be you really want to major or minor or double in math or maybe statistics. Computer science is very helpful. People who can write code are in very, very high demand. And I think back again, I have one observation here. You can't make inferences with one observation, but I'll do it anyway. So our daughter, one I just referenced, who just graduated from Notre Dame with a degree in, she was a double major, degree in economics and math, but she also has really good code skills as well. And she was very highly sought after for that. So, computer science would also be, something you would probably want to think a lot about.
For sure. And that kind of closely relates to the next question. There's obviously a lot of distress in the job market right now. So what are your thoughts on how it might look specifically for economists over the next few years once the vaccine is developed?
Well, that's a good question. I mean, I joke sometimes that we economists are counter-cyclical. And what I mean by that is when things are going really well, nobody cares. They're all geniuses. They can all do it on their own. And we're not that busy. When things fall apart and people want answers, we get really, really busy, right? And so, who knows what the workplace is going to look like 5 to 10 years from now. My guess is many of us will be working a little bit more from home. I mean, right now we're exclusively from home. I don't think we'll be exclusively from home 5 to 10 years from now. We will go back into the office, I think, because if nothing else, there's a lot of idea generation that happens when you're sitting next to somebody and you're talking about stuff. You can bounce ideas off of each other's heads. That's a little bit more difficult to do when you're sitting at home. I mean, yes, you can pick up the phone, you can get on a Zoom call, but it's not as easy as when you're sitting next to somebody in an office. And so, again, it gets back to why major in economics. Economics gives you an ability and it's a liberal arts degree. Liberal arts is all about critical thought, how to think. Economics is part of that, but it's the logic and the discipline of the theory behind economics. And those skills, I think, will always be valuable. And who knows where you guys are going to be 10 years from now. You could be doing something you completely aren't even thinking about now. But as long as you have the ability to critically think, those skills will always be needed in many different sorts of jobs. And so, yeah, I think it prepares, the discipline of economics, I think prepares people for lots of different career paths, and, you know, and how things evolve over time.
I see. And you kind of touched on this before, but like, what are your thoughts on how the job market for economists might, you know, react to automation and changing and advancing technologies over the long term?
Yeah, so I think, you know, I think about, you know, that. Are we going to be replaced by robots and AI and things of that nature? No, I don't think so. A lot of what we do is we go, you know, we go out, we talk to clients. I said I do a lot of public speaking. So, you know, we get up in front of, you know, audiences as small as 10 up to hundreds of people. And we talk about what's going on in the economy and how that may affect their businesses. You can't AI a lot of that stuff away. So that's going to be there. And I think what AI is, I'm becoming more and more of this view, AI is a tool to help us become more productive. Will it displace some jobs? Yes. You know, jobs that can kind of be digitized. AI is going to replace some of those sorts of jobs. But, you know, in terms of being able to explain concepts to people about something I know a lot about, the macroeconomy, that's not going to be AI'd away. I can use AI to help me look at data, to make sense of data. And so, you know, will it displace some jobs in economics? Sure. But, you know, in terms of being able to explain economics to whether it's Alan Greenspan or whether it's, you know, the people I go out and talk to today, that's not going to get automated away.
Yeah, I can definitely see your point there. So many of our members are also more interested in more of like entrepreneurship. So do you think an economics major would be a good choice for them? And if not, what would you recommend?
Yeah, I do. I do believe that, but I would say coupled with something else. And it gets back to what I said earlier about an MBA. I mean, if you're going to be an entrepreneur and you're going to be trying to run your own business at some point, I mean, I think you are going to need some of those business knowledge. You need to know something about finance. Now, will you have a CFO? Yes, right? But still, you can't be a dummy when it comes to finance. You're going to need to know a little bit of accounting, things of that nature. But, you know, again, with economics, and I know that there are some schools, so I know where my alma mater, UNC Chapel Hill, they do have an entrepreneur program there. It's not a major, it's a minor, but you know, it teaches different entrepreneurial sorts of skills. But, you know, not to keep beating a dead horse here, but, you know, the good thing about economics, it teaches a discipline, it teaches you how to think. And I think that you need those sorts of skills, you know, as an entrepreneur.
I guess moving on to some more macroeconomic questions. How has the rising student loan debt affected, you know, the real estate, automobile, and some of the other major markets?
Yeah, so that's a good question. So if I think of, let me start with automobiles first. So if you look at the run rate, and this is before the pandemic. So we were buying from 2012, call it 2013, up to 2019. Americans bought about 17 million units, 17 million cars a year. But that was also the run rate a decade ago. And we're a larger economy today, obviously, a larger population than what we were, you know, 10, 20 years ago. So what that tells you is not as many people have cars today as they did, or the per capita cars are lesser than what they did, where they were 20 years ago. Is that because of student loan debt? It could be. It's hard to know. But what's also happened is lifestyles have changed over the last 20 years. More and more people, as you know, are moving into cities, right? You know, kids who are just graduating from college, they want to live in Chicago, they want to live in New York, San Francisco, wherever, and they're not driving cars. So like when I graduated from college 40 years ago, it was different then. People, suburbia was a bigger deal back then. Everyone drove around in cars. Today, you know, with the movement back into cities, the lifestyles have changed, and fewer people are buying cars today. So I don't know how much it's affected the automobile market. If it has, you know, it makes sense if you have more, if there's more people out there with student loan debt, it's harder to qualify for an automobile loan than it would be otherwise. But I think my sense would be it's more of a marginal thing there. Has it affected the real estate market? Yeah, again, probably, with more people who have student loans. But underwriting standards today for houses are much more strict than they were, thank goodness, 15 years ago. You know, 15 years ago, there was these liar loans and things of that nature, and that doesn't happen anymore today. So, you know, if you walk into, you want to buy a house, you got a lot of student loan debt, it's going to be harder to do it. And so if you look at the home ownership rate today, it's a few percentage points below where it was back then. Is that all because of student loan debt? I wouldn't say all of it. Again, some of it's a lifestyle choice. Again, you know, young people are moving into cities and they're not buying homes, they're renting homes. So that's played a role there as well. But, you know, just to sum up here, higher student loan debt has probably hurt real estate somewhat.
For sure, that makes sense. So then, I guess, what are your thoughts on some of the proposed broad student loan forgiveness programs? Would they help to fix some of those issues you outlined?
I don't have a lot of really well thought out thoughts there, but what I will share with you, and this comes from my wife. She's a professor of political science at a university in Charlotte, and she's talked to you know, different administrators about student loan forgiveness sort of things, and you know, 100% of them say they think it's a bad idea to just completely wipe it away. They say you want to have people have skin in the game, right? You know, if it's like, if it's a free good, if education's a free good, or if you're wiping out student loan debt, that there's disincentive effects, you know, for that. So, and the other thing I think I would also point out in terms of student loan forgiveness, that is a very regressive sort of policy. Who has student loans? People who go to college, right? And people who go to college tend to be in the upper middle to upper sorts of income distribution. There's not a lot of really low income people who are going to college. And so if you're going to wipe out hundreds of billions of dollars of student debt, who benefits from that? It's people at the upper income levels. And, you know, politically, that is again, that's a very regressive public policy sort of thing. You know, if you're going to make up a number, $400 billion wiping out student debt, could that $400 billion be spent better somewhere else in the economy? I mean, that's a political question, and that's a value judgment. And I don't, you know, as an economist, I'm not well trained to answer value judgments, but keep in mind, again, that would be skewed towards the upper levels of the income distribution.
Yeah, that's definitely very important. I'd now like to give everyone the opportunity to ask questions that haven't already been answered. So remember, you can either write it out in chat, or you can put a question mark in the chat and I'll call on you. So just take a minute to do that. Yes, Margot, go ahead.
Hi, Mr. Bryson. This is sort of at a micro level, but say that you have money in a savings account. Why are interest rates so low? Like, why are they like 0.02% or 0.04%? And how does this relate? What is the effect of all these, people having very, very low interest rates on their savings accounts affect on the greater economic scale?
Yep. So where is that coming from? It's coming from the Federal Reserve. So when we went into this very, very deep recession, when the pandemic shut the economy down, the Fed slashed its interest rates, its target for short-term interest rates, essentially to zero. And so banks follow suit with that. And so if you look at all interest rates around the economy today, they're very, very low. And so banks, the way banks make money is they with checking and savings accounts, they pay interest on that, but they take that money and then they lend it out for different sorts of loans. And obviously, if a bank wants to make money, it has to charge a higher interest rate for the loans it's doing than for the deposits. And so because the whole level of interest rates are so low in the economy because of what the Fed's doing, that's why you see those interest rates so low. And the reason the Fed brought interest rates down as much as it did is to try to stimulate the economy, right? If rates come down, what we've seen is mortgage rates. Mortgage rates today are, I don't know if they're at all-time lows, but they're probably the lowest it's been since the 1950s or 60s. And so mortgage, really low mortgage rates helps to stimulate housing, which helps to get the economy back on its feet. Very, very low interest rates help to, so do you want to go out and buy a car? You need to borrow money for that. Really low interest rates make it more affordable for you to buy the car, etc. So it's all in response to the pandemic shutting the economy down, the unemployment rate going up as high as it did, and the Fed slashing rates to try to stimulate the economy to bring us back into a recovery expansion sort of mode.
Thank you.
You're welcome.
And Dylan, if you'd like to go ahead and ask your question.
Yeah, so I was wondering, you used the CPI price deflator in one of your slides. I was wondering if you thought that was the best deflator, or if you compared to like PCE or other inflation indices.
So that's a good question. So the reason I went to the CPI, used the CPI there, was, so the CPI is what's called the Consumer Price Index. And then, as a young gentleman was noting, there's another index called the PCE, which stands for Personal Consumption Expenditures Deflator. And that's a big term, but what do these two things mean? So the CPI is what's called a fixed weight index. Now, what that means is every month, people from the Bureau of Labor Statistics who collect this data, they go out to grocery stores, they go out to all sorts of stores and stuff, and they quote, buy a fixed basket, so they say, go out, and so the Bureau of Labor Statistics says, okay, how much is chicken? How much is beef? How much is a shirt? How much is a belt? Yada, yada, yada. Okay, and so that basket every month, it's the same sort of quantities in the basket, and they're checking on all those prices. Okay, frankly, the better index to measure prices is probably this PCE deflator. So CPI is fixed weight, which means every month you're buying the same basket of goods. The PCE is what's called a flexible weight, and what that means is, when you think about it, it's the more that we live our lives. If the price of chicken goes up relative to beef, you're probably going to buy less chicken and more beef. Where the CPI, you're going to be buying the same quantity of chicken and the same quantity of beef every month for the next 5 years or whatever, however they do it. So that PCE deflator is a better measure. Now, that said, the reason I just chose the CPI for that particular graph was I just happen to have the data laying there at my fingertips, and I could easily find the item for college tuition. It probably is in the PCE as well. I just didn't go bother checking it. My sense would be, though, that if I did it with the PCE versus the CPI, over 40 years, you're probably going to see roughly the same sort of graph, and roughly the same sort of quantities. Maybe the college tuition at the PCE level has only gone up 14 times rather than 15 as the CPI would show. But if we're talking 14, we're talking 15, who cares, right? It's, in general, they're going to be very similar.
And then Rochelle, if you'd like to go ahead.
Yeah. Hi, Mr. Bryson. I'm Rochelle. And I was just wondering, because of what we've seen about the economy in the aftermath of the Great Recession and because of this coronavirus pandemic, do you think that we're going to be rethinking a lot of economic theory in the future? Like, for example, if 5% should be our target for unemployment, and is there such a tight relationship between inflation and employment as there used to be?
Yeah, that's a really good question. And that rethinking is being done right now. As a matter of fact, it's being done at the Federal Reserve. A few weeks ago, Chairman Jay Powell had they've had at the Fed, they've been looking at their strategy and policy tools and tactics for the last year or so. And essentially what they're doing now is, rather than trying to target a 2% inflation rate, it sounds like a small change, but I think it's pretty big. They're actually going to try to hit 2% over some period of time. And again, it sounds like a small over an average inflation rate. The point here is they are not scared about bringing inflation up. If inflation 2 or 3 years from now is at 2.5% or 3%, they're going to be thrilled. And they're also going to try to let the economy run hot. So if you look at in the last tightening cycle, which started in 2015 and then went through 2018, the unemployment rate was coming down, and they started to tighten when it got to about 5%, because the thinking was, if it keeps coming down, sooner or later it's going to lead to higher inflation. Well, guess what? It didn't. And so right now, the official unemployment rate in the economy is 8.4%. I think that they're going to continue to bring it down, and they're just going to wait until inflation comes up. And so if 5 years from now, the unemployment rate is at 3%, and I'm making these numbers up, it's at 3%, but we still don't have any inflation, they're going to keep rates at 0. They're going to want to, there was an old saying years ago, so if you remember the Battle of Bunker Hill, right? The general who was in charge said, wait until you see the whites of the British eyes before you fire, okay? And so when you, in terms of monetary policy, it was, if you see the whites of inflation's eyes, it's too late at that point. You've waited too long. The Fed has rethought that now. And to your point, they're going to wait until they see the whites of inflation's eyes. They're going to wait until the inflation rate's at 3% and going higher before they start to hike rates. So, yeah, so there is a rethink going on right now in terms of a lot of stuff as it relates to economic policy.
Thank you.
Pranit, if you'd like to go ahead.
Yeah, hi, I'm Pranat. So a couple of days back, I was watching Bloomberg, and they're talking about this new stock exchange called the Long-Term Stock Exchange being launched in San Francisco or Silicon Valley, and it's centered towards a lot of tech companies. And right now, you see a lot of tech companies whenever they're going for an IPO, they usually do that in the NASDAQ. But now that the Long-Term Stock Exchange is here and it's really centered towards tech companies, I was wondering how that was going to affect exchanges like the NASDAQ that get a lot of returns from tech companies like Microsoft and Apple and Google. So that was my question.
Yeah, so first of all, I don't know anything about this particular sort of stock exchange. And I guess what I would say is if there's real benefits for companies to be issuing there, maybe there's a larger pool of investors, or something along those lines, or maybe the transaction cost in that particular stock exchange are lower than the transaction cost in, say, the NASDAQ, then over time that will eclipse, the NASDAQ. But without knowing a little bit more exactly what they do there, how it's going to be different from the NASDAQ, it's difficult to say. Will it have a huge effect on the overall macroeconomy? I wouldn't imagine that it would be. Unless it allows people to raise more capital at lower cost, that would have a potential effect. But if all it's doing is just replacing the NASDAQ, then as a macroeconomist, I look at that and I say, well, it doesn't really have any macro sort of effects. It has an effect if you're working at NASDAQ, but on a macro scale, it doesn't.
And Nikita, that'll be our last question if you want to go ahead.
Thank you. So I was wondering if you could talk about the differences between the public and private economic sector jobs in terms of growth.
In terms of growth, that's a good question. It's a really good question. I think what's probably has happened over time is, and I don't have any hard data, but this is just my sense. I know that not as many companies have economics departments as they did 20, 30 years ago. We're not inexpensive. And so in an effort to try to streamline and cut costs and things of that nature, some private sector firms have gotten rid of their economics departments. The economics departments at banks, Wall Street sort of banks, are larger today than they would have been, because we're getting, a lot of those clients are calling on us, to provide that economic information. So there's been a specialization that has occurred, like many other things over the last 20 or 30 years. More broadly, when I think about the public sector and the private sector, and I've lived in both of them. The public sector is, if you like jobs, so that's biased towards job security. It's very difficult to fire somebody in the public sector. So if you get your foot in the door at a Fed, or the Treasury Department, or wherever, I don't want to say that's jobs for life, but there's a lot of job security there. The trade-off is those jobs don't pay as high as private sector jobs do. The private sector is very well remunerated, but there's no job security. I could wake up on Monday morning and find out I can't log into my account at Wells Fargo because I've been displaced. I'm hoping that's not the case, but we all have that hanging over our head. So there's a trade-off there, right? What do you like? Do you like this? Do you like the known thing? If you do, it's like any other thing in finance. There's a trade-off between risk and reward, right? If you don't like a lot of risk, then you have to settle for lower rewards. And if you like, if you're willing to settle for a lot of risk, then you should want a lot of rewards. So so for me, that's kind of the trade-off between the two. And again, I think private sector economics roles, pure economics roles, doing what I do, those jobs today, I'm going to guess, there's fewer today than there were, say, 20 years ago. In terms of the public sector, I don't really know. Probably it's been flat or so. But I think the real thing you got to think about is the trade-off between risk and reward.
Yeah, those were some very interesting questions and responses. We're about out of time, so I'd like to thank everyone for coming, and especially thank you to Mr. Bryson for coming to speak with us today. I'm sure everyone learned a lot about economics in college, careers in economics and the rising student loan debt. So yeah, thank you everyone, and you especially, Mr. Bryson, for coming. I'll send out a feedback form later to everyone, so please fill that out when you receive it. And then we'll launch more, we'll be sending you more information about this in the coming days, but we are announcing our international forum for Saturday, September 26th. So thank you, everyone.